Angela Snyder, founder and CEO of Taxonista. Let's chat about LLCs, SCorps, and partnerships. LLC and PLLC are organizations that are formed at your state level. They are not recognized by the federal government. It is at the state level. So typically we recommend that a business starts off by creating an LLC or PLLC. PLLCs are typically required for like real estate, medical, attorneys. Different states have different requirements for whether you can get a PLLC or an LLC. So it's very important to take a look at those state requirements. Now, after you've become an LLC or PLLC, then you can become an elect to become an S corporation with the federal government. So again, it is an LLC or PLLC with the state, and then an S corp with the federal government, okay? Other ways you can do with your LLC or PLLC is you could become a partnership. So a partnership is two or more individuals or entities that come together and form a business. In some states, it can be a husband and a wife. In other states where it is community property, it does not need to be a partnership as a husband and wife in those states. There's different benefits between an S-corp and a partnership. So if you elect to become a partnership, everything is based upon the partnership percentages. However, you can designate different percentages for different things. So with a partnership, you can make that very complex, very intricate, and very detailed. You have lots of flexibility. So for instance, in a partnership, you might be able to say, let's say there's 3 partners. You might be able to say that the first one takes over all the losses because they were the money person at the time. And so now they're going to recoup all of their investment by taking all of the losses. So they're going to get 100% of the losses until their investment is recouped. And let's say that one of the partners was only there for half the year, and it's a 25% partner, but they were gone and completely non-existent for certain months during the year. Then you're able to carve out that time period, and that either that time period or those jobs or those projects where that particular partner was not a party of that engagement, and carve them out of the amount for either profit, loss, or distributions. So with partnerships, this is just the tip of the iceberg. It can be extremely complex. You can basically say and do what you specifically want to do. Now, in an S corporation, you have to make an election with the IRS and has to be accepted for you to continue. With an S corporation, everything is specifically about the percentages. There is no fluctuation, no deviation. All right, so it is whatever percent you own is whatever percent of either the distributions, the profit that you have to report. It is all 100% percentage based. Now, there are more tax advantages with an S-corp for the smaller businesses because partners are taxed 100% up to the Social Security cap on their partner K-1 earned income, whereas an S-corp is only taxed as a self-employment on their W-2 wages. They do not get self-employment on their K-1. That's just a top-level overview. So there's so many different things that can go on between an LLC, PLLC, partnership, and S-corp. One thing to keep in mind is that there is no such thing as an LLC or PLLC tax return at the federal level. It must be determined as whether it's going to be a Schedule C, sole proprietor, or just you, an S corporation because you made the election and you got it accepted, or a partnership because by default, you do not have to make any election, but by default, you are a partnership based upon the fact that 2 individuals or entities form a business at one time. Hopefully that sheds just a tiny bit of light on that for you and helps to explain the differences.